So many times it happens that a company is facing a financial crisis, but at the same time, it also owns a valuable property. But it cannot sell this property because it has to use this property in its business. It is during these kinds of circumstances that we do see designing of a sale and lease back transactions. What happens in a sale and lease back transaction is you will first sell your valuable property. The buyer will pay the consideration, so your financial requirements are satisfied. And then the buyer will lease the asset back to the seller. So you are also not deprived of your right of using that particular asset. So you are able to raise the necessary financial resources, and at the same time, you are still able to use the asset. So that's what we consider as a sale and lease back transaction. In a sale and lease back transaction, the seller will later on become a lessee and the buyer will later become a lessor. Right, you're having party A and party B. A is selling the asset. So first there is a sale of the asset. So right now A is the seller, B is the buyer, and then as we understand, it will be leased back, right? B is leasing the asset back to A. So B is becoming a lessor in this transaction and the seller is later becoming a lessee. This is, as I said, a sale and lease back transaction. You sell the asset, get the necessary money. Now you can use this particular money to tide the financial crisis that you are facing. And you are also enjoying the right of using the asset. So how should a sale and lease back transaction be accounted for under Ind AS 116? Okay. I have this chart ready where we will discuss how the sale and leaseback transaction can be accounted for. Yeah, as we understood, the seller is now becoming a lessee and the buyer is now becoming a lessor. The question that we should ask ourselves is, further accounting treatment will depend upon this question. Is control of the asset transferred by A to B? A is the seller, B is the buyer. In other words, is the buyer controlling the asset? So we have to ask ourselves, is the control getting transferred? Now, whether control is getting transferred or not, this will be decided by Ind AS 115, revenue from contracts with customers. Ind AS 115 has laid down the conditions, or I will say laid down the framework, where we can consider whether the control has been transferred or not. You only ask yourself, if you are buying some asset, when can you say you are controlling the asset? When can you say you are controlling the asset? Ind AS 115 says that, we can say that the buyer is controlling the asset if the buyer can direct the use of that asset. If it is the buyer who is enjoying the benefits of ownership. If it is the buyer who is bearing the risk of ownership, it is the buyer who can prevent others from enjoying the benefits of ownership. So that is when we can say that control has been transferred. So when A is selling to B, when A sells to B, ask yourself, is it B who is now enjoying the risk and rewards incident to ownership? Is it B who is controlling this particular asset? If your answer is yes, it is B, then we will say it is a sale and lease back transaction. We also use the word purchase over here because we are also seeing it from the viewpoint of the buyer. But if I see it strictly from the viewpoint of the seller, then I will say it is a sale and a lease back transaction. If the control is not getting transferred to B, we will say it is simply a financing transaction. Think in this way. A is selling the asset to B. But when you study the contract, the contract says that A shall buy back the asset. A shall buy back the asset from B after 5 years. This is what is mentioned in the contract. It is further mentioned in the contract that A shall direct the use of the asset. So A shall direct the use of the asset. When? During these 5 years. So let us say this is the kind of arrangement which is there between A and B. A is in need of money. So A is selling this property to B. A is selling this asset to B. But the condition is that after 5 years, A will buy back the asset from B. A is also saying that, see, during this 5 years, you will lease the asset back to me, and it is me who will direct the use of the asset. Ask yourself, who is enjoying the benefits of ownership? Is it A or B? I am selling the asset to you, but I am making it very clear that, see, even though I am selling the asset to you, you will lease the asset back to me, but during these 5 years, I will enjoy whatever are the rights of directing the use of the asset. So although I am selling the asset to you, although A is selling the asset to B, it is A who is enjoying all the benefits of ownership. It is A who is undertaking all the risk of ownership. We will say that here control is not getting transferred. We better consider this as a financing arrangement. Because one will really wonder that what is there in B over here? A is selling the asset to B, but B is not enjoying the benefits of ownership. B is not directing the use of the asset. B is not able to stop A from enjoying these benefits. Then why will B ever enter into this kind of a transaction? The reason why B will enter into this transaction is because ultimately when A will make the payments, A will pay for the asset and A will also pay for the interest. I am in need of money. You have a lot of money. I want to borrow money from you, but you are saying, what about a security? So I tell you that, okay, I will sell the property to you and after 5 years, I'll buy back from you. Okay, in case if I fail, let's say I'm not able to buy this property back from you after 5 years, still your position is secured. I've already sold the property to you, right? The legal rights are lying with you now. So in case if I fail to repay the borrowing, then you can sell this asset in the open market and make good your loss. So it is on the strength of this property as a security that you are advancing money to me. You are not interested in the lease transaction. You are not interested in the sale transaction. All that you are interested in is that over the period of 5 years, when I will pay the lease rent, you will charge the lease rent in such a manner that you are earning a reasonable rate of interest. So you are basically getting into this transaction because of the financial income. And that's the reason we will say that this is purely a financing transaction. Getting it? So it's very crucial to establish the control. If you say that yes, control of the asset has been transferred, then it is a sale and lease back transaction. If you say no, simply a financing arrangement, right? So further accounting for a sale and lease back will continue if the answer over here is yes. A sells the asset to B and the control of the asset is transferred to B. So this is a sale. Okay, then B is leasing the asset back to me. So that's a lease. So sale and lease both are taking place. So if it is a sale and lease back transaction, how shall the further accounting be carried out? We shall first discuss the accounting in the books of the lessee. I have broken it down into simple steps for you so that the understanding becomes that much easier. Okay. The first step in the books of the lessee is that you should measure the sale proceeds at fair value. See, whenever you are planning to sell this asset to the other party, it is natural that there shall be bargaining and negotiations. And finally, we will arrive at a price which is mutually agreeable to both the parties. This price which is mutually agreeable, that is what we will call as the fair value. In an ideal situation, sales value and fair value both will be equal. What if it is not? If it is equal, then the accounting will be really simpler. But what if it is not? What if there is a difference between the sales value and the fair value? So two possibilities are there. Sales value is higher than the fair value, or sales value is lower than the fair value. Okay. So what we are saying is something like this, that the fair value of the asset, okay, the fair value of the asset is turning out to be 10 lakhs of rupees, okay, 10 lakhs of the rupees, but the ultimate sales value is turning out to be 15 lakhs. The real worth of the asset is 10 lakhs, okay, but 15 lakhs is decided as the sales value. So it's happening in this way. A sells to B an asset which has a fair value of 10 lakhs. So B now has to pay the consideration. B is paying 15 lakhs for an asset which is worth 10 lakhs. So one really wonders that what is this extra 5 lakhs? Why will B pay this extra 5 lakhs? This extra 5 lakhs will be considered as additional finance. We understood earlier that when shall we enter into these kinds of transactions? Most of the time sale and leaseback occurs when the seller, who will later on become a lessee, is in need of money. You know your asset is worth 10 lakhs, but your financing requirements are not 10 lakhs. You require more money. So you tell B that, see, I'm offering you an asset worth 10 lakhs, but I need 15 lakhs of rupees. So this extra 5 lakhs that you are receiving is not towards the asset. This extra 5 lakhs that you are receiving is towards additional finance. You need extra money, and that's the reason the buyer is giving you this extra amount. So that's what they really say. What if the sales value is greater than the fair value, or the present value of the lease payments is greater than the present value of market lease payments? Okay, you are going to pay more than what the going market rate is. They say difference is recognized by seller lessee as reduction in the sales value and an additional financing received from the buyer or the seller. You get my point? So what they are saying is that the sales value, you should record the sales value at 10 lakhs. Whatever extra amount you are getting, you should deduct it from the sales value. See, they say difference is recognized as reduction in sales value. Sales has to be compulsorily recorded at the fair value. So difference will be deducted from sales value, and we will treat it as additional finance received from the buyer lesser. So this 5 lakhs is additional finance. Understand? Now when you pay the lease rent, let us say you are supposed to pay a lease rent of 2 lakhs of rupees. Let's say you're supposed to pay a lease rent of 2 lakhs. Remember one thing. The buyer is charging you for the asset. Buyer is also charging you for the additional finance. Buyer is later on becoming the lessor, right? Now the lessor quotes a lease rent of 2 lakhs. When the lessor quotes a lease rent of 2 lakhs, entire 2 lakhs is not for the asset, because the asset is actually worth only 10 lakhs. So the lessor is recovering 10 lakhs. Lessor is also recovering this extra 5 lakhs. So a part of it is for the asset, a part of it is for the additional finance. What is the other possibility? Well, the other possibility is that the fair value is 10 lakhs, but the sales value decided is only 8 lakhs. So this time the sales value is turning out to be less than the fair value. What to do now? Ind AS 116 says that whatever is the difference, here the difference is turning out to be 2 lakhs. This difference of 2 lakhs should be added to the sales value. It is compulsory to record in the books of the lessee the sales value at the fair value. So I'll have to increase it. Earlier I was deducting from the sales value. This time I'll have to add it to the sales value. And this difference of 2 lakhs will be treated as prepayment. It will be considered as the prepayment of the lease. This time you are selling an asset worth 10 lakhs, but you are getting in return only 8 lakhs. So the lessee is arguing that, see, in this kind of a situation, my lease payments will be on a lower side. consider as if lease payments of 2 lakhs are already prepaid. As if I have already made an advance payment of it. In the earlier case, the lease rent will be higher because the buyer will recover the asset. The buyer will also recover for the extra money that he or she has provided. But that will not happen over here. As a buyer, you are paying less. So as a lessor, you will receive less. You will receive lease rent less than what the market going rate is. Because the lessee will argue that since you are paying me less in the very first place, I will consider as if the lease rent to that extent has been prepaid. So the liability to that extent is prepaid, and that's how further accounting will be done. So if you see here, the sales value is lower than the fair value, or we can say the present value of the lease payment is lower than what it will be at the market going rates. They are saying that difference is recognized by seller lessee as addition to sales value and addition to ROU asset as a lease prepayment, as if you have made an advance payment of the lease rents. So very quickly, if we just run through the first step, it is compulsory that you should be measuring the sales value at the fair value. If sales value and fair value both are same, life is simple, right? But if the sales value is higher than the fair value, then the difference will be considered as additional finance received. If the sales value is lower than the fair value, we will consider as if a part of the lease liability has been prepaid. Step 2. Measure the lease liability at its present value. We know it very well. The lease liability has to be recognized at its present value. So that's the step 2. Step 3 is the segregation. As we have understood, lease payments will be required to be segregated into how much is for the additional financing, how much is towards the lease. Whatever is towards the lease, that will turn out to be a balancing figure. So it is this that has to be accounted for. As we were discussing earlier, your lease rent is 2 lakhs. You are charging for the asset. You are also charging for the financing. So figure out this, and then the asset will be a balancing figure. Fine. Okay. The next issue will be now with respect to the ROU asset. A sale and lease back, it's a very typical transaction. You have an asset. Remember, you are selling the asset. So to that extent, the asset is getting transferred. Then the buyer is leasing the asset back to you. And now you will be again using that particular asset. So the asset is also retained. You get my point? You have this property, you are in need of money, so you are selling it to the other party. That means the asset is getting transferred. Then the buyer says, okay, I'm giving the asset back to you. Now you use the asset. So that is again a lease transaction. See, we are seeing this from the viewpoint of the lessee, isn't it? So the lessee is getting the asset back. We know in case of lease arrangement, the lessee has to incorporate the ROU asset. But then that ROU asset is the asset that you had sold in the first place. So you are selling the asset, so there is a transfer. You are getting the asset, so there is an asset retained. The asset retained, that has to be reported in our books as the ROU asset. And the asset that you have transferred, you should recognize some gain or loss. I hope you agree with my argument. What I am saying is that the asset is getting transferred. So if it is a sale transaction, in a sale we will recognize selling profit or loss, which will ultimately get transferred in the P&L. And as a lessee, when you get the asset back on lease, you will have to recognize the ROU asset. So how are we going to report the ROU asset in our books? How are we going to decide what is the gain or loss to be recognized? Okay. This will be done on the basis of the lease liability. What is the exclusive lease liability? By exclusive lease liability, I mean something in this way. Right, earlier also we were arguing that if the lease rent is 2 lakhs of rupees, let's say, then certain amount is for additional finance whilst the rest of the amount is for the asset. Okay, let's say we come to the conclusion. I'm just giving an example. Let's say we come to the conclusion that additional finance, it is 10,000 and 1,90,000 is for the asset. See, this will give you total liability. Understand? This will give you total liability, while this will give you exclusive lease liability. Do you agree with me? Every year you are supposed to pay 2 lakhs of rupees, so that's your total liability. But you as a lessee know that out of that 2 lakhs, some amount is for that extra money that we got from the buyer, while the rest of the amount is for the asset. So this will give me, when I discount 2 lakhs, I will get total liability. But when I discount 1,90,000, I'll get exclusive lease liability. We know that in the books of the lessee, ROU asset will be recorded at cost. Recall, what is cost of ROU asset? Cost of ROU asset is the present value of the lease liability plus any initial payments that you are making to the lessor minus any initial incentives that you are receiving from the lessor plus any direct cost incurred for effecting the lease plus present value of any dismantling costs, right? That's how we work out the cost of the ROU asset. So one of the main components of cost of ROU asset is nothing but the lease liability. So when you say that this asset will be retained and reported as an ROU asset, the exclusive lease liability will play a role over here, because cost of the ROU asset is ultimately measured with reference to the lease liability. So we take some figures and try to understand that how will this be recorded. Okay, let's take a simple situation. By simple situation, I mean, let's consider the sales value and the fair value both are equal. And let's understand how the asset will be recorded and how the asset which is getting transferred, gain or loss, will be recorded. Okay, let's put it in this way. Let us say the fair value of the asset is 10 lakhs of rupees. Okay, and the carrying amount of this asset, let's say, is 8 lakhs. That means the total gain, in a way we can argue, if it was a simple sale transaction, then the total gain is turning out to be 2 lakhs. Now, how shall I recognize the ROU asset? For that, as I said, you should calculate exclusive lease liability. I'll work out the exclusive lease liability. Let me frame a short form over here, ELL. Let us say the ELL is turning out to be 6 lakhs. So just see, how will I recognize the ROU asset? You should recognize ROU asset with reference to the lease liability. As I realize my lease liability is 6 lakhs and this lease liability is for an asset which has a carrying amount of 8 lakhs. So I'll multiply this by 8 lakhs and I will divide it by the fair value. So I divide it by the fair value. What I'm doing is I am recognizing the ROU asset retained with reference to the carrying amount. See, an asset will be shown in our books at the carrying amount. Okay, an asset will be shown in our books at the carrying amount. So with proportion to the carrying amount, I am recognizing the ROU asset. Because it's an ROU asset, it has to be recognized with reference to the lease liability. So I'm taking the lease liability and multiplying it by the proportion of the carrying amount in the total fair value. So as I do this, right, I get 4,80,000. So ROU asset will be reported in my books at 4,80,000. Comfortable? It's a sale transaction. I sell the asset. Whenever you sell the asset, it has to be de-recognized at the carrying amount. But then asset is obtained back on lease. So now it should be reported as ROU asset. ROU asset, as I said, should be measured at the lease liability. So I'm taking the lease liability as my base, which in our example is 6 lakhs. And since you are going to show this asset in the books, asset is always shown at its carrying amount. So I will take the proportion of the carrying amount to the fair value. And I realize it's turning out to be 4,80,000. So I will incorporate as a lessee ROU asset of 4,80,000. Okay. Now what about the gain or the loss? Remember, to the extent you are retaining the asset, you cannot show gain or loss. I can show gain or loss to the extent of the asset that has been transferred. So whatever asset is retained, right? Whatever asset is retained, to that extent, I cannot show any gain. So I argue something in this way. That let me take 6 lakhs of rupees. The total gain is turning out to be 2 lakhs, right? The total gain is 2 lakhs of rupees over here. So gain is turning out to be 2 lakhs. And the total fair value is 10 lakhs, right? So 6 lakhs is there, 2 lakhs is there, and 10 lakhs is there over here. So this is turning out to be, yes, 6 into 2. So it's turning out to be 1,20,000. So 1,20,000, just a second. Yeah, so 1,20,000 is turning out to be the gain for the asset that is retained. This cannot be recognized. Whatever is the asset that is retained, to that extent, I cannot recognize the gain in my books. But it just means the balancing figure can be recognized in our books. So, what is getting transferred? Total gain is turning out to be 2 lakhs. Okay. From that, 1,20,000 will be deducted. So I am getting 80,000. I will consider 80,000 rupees as the gain that can be recognized in our books. Getting me? To the extent the asset is there in our books, to that particular extent, we are not in a position to show the gain, but the balance gain can be considered by us. It's all there, right? It's all there over here. Just see. Step 3, as I said, segregate the lease payments into how much is for additional financing and how much is for the lease, right? So that's how we will find out exclusive lease liability. Discounting this, okay, discounting this will give you the exclusive lease liability. This exclusive lease liability, if you see in our example, exclusive lease liability was 6 lakhs. The cost of the carrying amount was 8 lakhs and we divided this by 10 lakhs, right? So we are getting 4,80,000. This 4,80,000 I'll show in my books as the ROU asset. Okay. Then the total gain or loss. In our example, the total gain or loss is 2 lakhs. Exclusive lease liability in our example is 6 lakhs. The total gain is 2 lakhs. That I am dividing by the fair value, which is 10 lakhs. Solve this. This is 2 lakhs minus 1,20,000. So that's turning out to be 80,000. 80,000 of gain can be recognized because this is the gain for that portion of the asset which has been transferred by us. This portion, okay, this portion that you are calculating, this is gain for the asset that has been retained. The asset which has been retained, you cannot show gain or loss. So I'm calculating that and deducting it from the total gain. And then I realize that 80,000 is what can be recognized in our books. So as we know in accounts, nothing ends without an accounting entry. So the treatment that we have carried out for the sale and lease back, what is the accounting entry that we can record? Say we are selling the asset for 10 lakhs of rupees. So bank account will be debited by us for 10 lakhs, right? Then we have to incorporate an ROU asset. So ROU asset, I debit by 4,80,000. We are selling the asset. So whatever asset we are selling, it should be derecognized. The asset will be derecognized at its carrying amount. So I will say to PPE, in our example, the carrying amount is 8 lakhs. There is going to be a lease liability now in our books. Let's call it as financial liability. So we say to financial liability. In our example, it's turning out to be 6 lakhs. And here it is, the profit that needs to be recognized. So I say to profit and loss account, 80,000. So this is the accounting entry that we will be recording in our books for the sale and lease back transaction in the books of the lessee. What about the lessor? Well, the accounting in the books of the lessor will be much simpler. They are saying recognize the underlying asset at its fair value. As a buyer, you are going to pay cash, so we should recognize that at the sales value. And the difference between the two is financial asset or a financial liability. In our example, we are buying the asset for 8 lakhs of rupees. So the PPE or the asset, right? It can be even an intangible asset, fine. So PPE account, we are debiting by 10 lakhs. And we had made a payment of also 10 lakhs. Our example was an example where the sales value and fair value were the same. But in case if the sales value and the fair value is not the same, then there will be a difference in this accounting entry. If it is a receivable, record that in the books of the lessor as a financial asset. And if it is a payable, then recognize that as a financial liability. So that will complete the full accounting of sales and lease back transaction.